Okay, in Chapter 5, we're going to talk about interest rates and how they're ultimately created, if you will, or how we determine interest rates. So we're going to go through that process. It's primarily an economics topic, but certainly it has impact on finance and certainly on the cost of gathering money. So let's just kind of start talking a little bit about something called the effective interest rates. One of the challenges that we have is that we have different kinds of assets have obviously different cash flows, but cash flows that come at different time frames. So we want to be able to evaluate interest rates when they have different compounding frequencies. So the idea of an effective interest rate tells us the actual interest rate that's paid or earned given the effect of compounding. The annual percentage rate is the simple interest rate. It's the given interest rate, if you will. So typically it's going to be less than the effective rate because it is that stated amount. In fact, when we talk about interest rates, the interest rate that you always discuss is the APR, the actual annual percentage rate. We then, to make comparisons, we have to do the math to bring things together so that we can look at an understanding of how things equate over time. So here's an example. We have an interest rate, and it's a 6% interest rate, and we can go down through here. If we could open the time value spreadsheet to see how this ultimately works. I mean, really, it just works with changing the compounding frequency. And we have 6% on that other slide, and certainly you can see how it's different as you add the different compounding frequencies. But we can do that quite simply. Here's 5%. What if it's semi-interest? If you look over here at the effective interest rate, if it has annual compounding, it's 5% is 5%. Semi-annual changes to 5.06%. And as we do this, what I'd like us to kind of concentrate on, let's change this little scenario. Let's go to negative 1,000 as the investment instead of the present value. Now, as you can see here, with a annual compounding, 5% is $1,050. But if you compound twice a year, there's more money there, an extra 63 cents. Not a lot more, but it is more, so that gives us an effective interest rate that's different, the actual interest rate earned. So if you go to 12, it goes from 1050.63 to 1051.16, and of course you can see that the interest rate again rises. So again, I mean, the idea here is that the interest rate changes obviously when you compound things. We could use this with looking at loan payments and calculation of loan payments. Here we have a $30,000 car loan. It has 60 payments. It's computed as a 6.75% APR. And again, we can go to our spreadsheet. Let's find the loan analysis spreadsheet. Work your way back here. You can find it. It's alphabetical, so it's not too hard to find. There you find it. Again, go back to our ideas, $30,000. Another zero, $30,000. 5 years is the time frame, 12 months, interest rate 6.75. Get rid of this piece right here. And of course, what we can see now is there's that $590.50. So what else can we get from this? If you made all years if you don't make any extra payments, it's going to take 5 years to pay this off. The total amount you're going to pay is $35,000. And in this case, since we started with $30,000, that must mean that the financing cost is $5,430. But what if we said, you know, look, I'd like to pay an extra, let's just make it an extra $50 a month. If you made an extra $50 a month payment, obviously the payment now is actually going to be the combined amount here, right? 630. That's going to knock about a half a year off, and it's going to save us about $512 in interest. So again, you know, understanding how the compounding frequency works is obviously an important part of understanding financial decision making. So again, we're talking about, we have this nominal interest rate, that's the number that's quoted, but there's also other interest rates. There's a, what we want to kind of look at here is the creation of interest rates in general. So the real rate of interest rate is the rate of growth of purchasing power. That's after we adjust it for inflation. So really there's a minimum amount, and here's where we kind of have a formula that we can plug into. The R star here is what's referred to as the real rate of return. Again, sometimes it's an R, sometimes it's a K, depending on your textbook. Let's make it R. So R star here is the equilibrium rate. It's created by the supply and demand of money. The inflation premium is obviously added to that to show the impact of inflation for the asset. Those two things added together, the real rate and the inflation rate, create the risk-free rate. Talk about how we find that, and we'll actually look that up when we get to class. And then finally, RP here is the risk premium. So if we had a treasury bill, treasury security, the rate of return on or the return you would expect to get on a treasury security would just be the risk-free rate plus risk premium. But since it's a treasury security, the risk premium is 0. So treasury securities are essentially looked at as being a proxy for the risk-free rate of return. So here we have an example. Again, we can do this with our Fisher effect spreadsheet. So again, if we kind of go back here, find the Fisher effect. The Fisher effect essentially is the mechanism, or is the theory, if you will, of how interest rates are created. So in this case, as we look at this, we can solve for some numbers. So we're told that the one-year government bond rates were about 3.3%, and inflation was about 0.1%. So at the end of 1 year, interest rates were about 0.3%, and inflation that year was about 3%. So how can we discuss or talk about what the real rates were? So in the first year, 3.3, inflation premium was 0.1. That must mean that the real rate of return was 3.2%. What about in the next time frame? Again, 1 year rates, so again, were about 0.3%, and inflation was about 3%. So again, I think I have the wrong numbers in here. So let's kind of look at this. If we go up here, and I want to do, excuse me, I want to be over here, right? So I want to put in here 0.3. Now notice that came out 30, so I have to check that, 0.003, 0.3%. 3% is inflation. So again, we end up with about 2.62%. So we're off a little bit here. This number here should be 0.3 instead of 0.1. But the idea here is just, you know, what is the actual rate of return on our money over time? So in this case, the real rate, 3.2%, and with respect to the later time frame, we actually had a negative rate of return. So you actually were losing money. If you invested in things like treasury bonds, you were actually losing real purchasing power. One of the little graphs I think is kind of interesting is this, just to show how, when we talk about using a proxy, how closely does the interest rates of treasury securities and inflation, how closely do they follow? And as you can see here, it's pretty close. That when the nominal rates of interest are going up on treasury securities, inflation's going up, and vice versa. I mean, it's not a direct match, but it's a pretty close match. So essentially what this picture shows us is that we can use the interest rates on government securities to also have a little bit of an understanding about how inflation works. If you assume that the real rate is constant, if you assume that this R doesn't change very much, then the only thing that changes risk-free is inflation. So if we could graph that over time, we might be able to have, or we'd have an indication of what our prediction of inflation was during that time frame. So what happens in the decision-making world when interest rates change? So here we have an example. I don't think we need to necessarily go to the spreadsheet to work our way through this example, just to make our point. But it costs $10 million for this project, and for the next 3 years you get $3 million a year. The interest rate, the risk-free rate, or the interest rate on this time is 5%. So that means that the net present value on this project is $0.638 million. So it's positive, so that means obviously it's a good investment. So the next question is, what happens if the world interest rates in the economy go up, or the riskiness of this project increases, and we go from 5 to 9%? What happens to the value? The net present value of this project changes. Well, let's double check this, because that thing didn't say it was right. So let's go back, and this is always I always like to go back and occasionally check from time to time, just to make sure that the numbers that they show us, or that we've calculated, are the right numbers. So it's a good exercise. So let's go ahead and do this. So we have negative 10, and then we have 5 years. Excuse me, that's 4 years of 3 million, and interest rates are 5%. So as you can see here, we end up having a net present value is that 0.64. So we have 0.64 million. If we expanded that a little bit, maybe we could make we can show there's the answer that we had before, that 0.638 million. So now what happens if interest rates go from 5 to 9? Well, what would you expect? Well, if you kind of think of it in simpler terms, if this thing becomes more risky, then it's less valuable. You don't want something that's more risky. So how are you going to buy something or how are they going to get you to buy things that are more risky when you don't want that? Well, the only way that can happen is if the price is lower. So if we change the interest rate to 9%, the number now goes to negative 0.0281. So let's go back to our notes. We see that there's actually a negative sign missing here. So we need to change this. Oops, I can't change it. But that should not be 0.28 million, but it should be negative 0.28 million. So now this project is no good. So the general rule is when interest rates increase, the value of all assets go down. So what happened when in 2008 with this financial crisis, right? The Federal Reserve responded by essentially changing its short-term interest rates basically to zero. So what did this do to the economy? I mean, you would think that in the short term, if the interest rate for banks, etc., to borrow money was zero, you would expect them to lend a lot more money, right? The cost of borrowing money went up. However, even though the prices of things were going down, consumer prices were falling, inflation rate was negative. So even if it had a zero nominal interest rate, the real rate of return still remained positive. Again, how does that work? Well, it's a negative sign. So if you subtract the negative, you're adding. So we ultimately end up with a positive real rate, even when the nominal rate was zero. So just to kind of move on a little bit and discuss a little bit about interest rates and how we find them in the economy, there's something referred to as the yield curve. The yield curve is a graph of the interest rates today over a certain time frame. So here you see we have time frames, Again, if you assume that this is today. But if you go out, here's a half year, 1 year, clear out to 20 years. These are Treasury securities. And if you were to go to the newspaper on November 6th, these are the interest rates that you would find in the economy for that time frame. This is what you'd find November of 08, of 07, and then November of 08. So these are 1 year apart. And you can see that over time, the yield curve was actually sort of downward sloping, fairly flat, but downward sloping. Then it started upward sloping, and then finally, in November of 2008, it has a pretty decent upward slope. So the questions we have is, how are these interest rates created? First of all, what is this a picture of? This is a picture of the risk-free rates of returns, the returns on Treasury securities over time, but they're looked at on a specific day. We can go to a website and see how this ultimately